you know that sellers hate contingencies. They don't want to wait while you get your house sold. So if they've got multiple offers in front of them, offers that are contingent upon the sale of a home are amongst the first that they will tend to throw out. So if you're stuck in this position and want to make a competitive non-contingent offer, but your home is not sold, that's what we're going to talk about in today's video. And hey, if you like today's video, you know what to do. Please give it a thumbs up. It means an awful lot to me and supports the channel. So you decided that the old house is too small and you need to move up. That's a big decision. But the next decision is, how are you going to get your offer accepted when you've got a house to sell? So if the market is slow, sometimes you can make an offer that's contingent upon the sale of your home. So the seller is waiting while you get your home sold. So that's where a bridge loan can come in and be helpful in that transition to your new home. A bridge loan is a temporary second mortgage on your existing home that allows you to borrow against the equity that you've got in that home to use as a down payment in your next home. And the mortgage payments are interest only, so they keep the payments low. And the bridge loan is paid off when you sell your house. If you've got equity remaining after that, that's yours to keep. The goal for a bridge loan is convenience. It's not for long-term financing because obviously you want to get your home sold. So you're pulling equity out of your current home. You're using that as a down payment on the new home. You're making an offer that is non-contingent. And when your old home sells, you're going to pay off the bridge loan. This lets you make a non-contingent offer on your dream home without waiting, without moving twice, and without asking the seller for their patience. Well, let's talk about the downsides to it. Until you have sold your home, you have 3 mortgage payments. You have your new mortgage payment, you have your old mortgage payment, and you have the bridge loan payment. And even though that's smaller, you're carrying a lot of payments that you don't normally carry. And you also need significant equity in your home. If you just recently bought your house and put minimum down, you probably don't have enough equity in order to even make this work. And sometimes that bridge loan lender will tend to be a little bit more restrictive in terms of their qualifications for this buyer because they're the ones that have the risk in this situation. So generally speaking, they want to see stronger credit, lower debt to income ratios, etc. This is where most people don't qualify, and that's okay. If you stick around to the end, I'll show you another idea for bridge financing that does not require the equity in your home and is more flexible in terms of qualifying. Let's look at a simple example. Say your current home is $350,000 and you owe about $200,000 on it. The difference between $350,000 and $200,000, that's your equity. You have $150,000 of equity in the property. The banks and credit unions that will offer bridge financing are not going to lend you all of that $150,000, but they might offer up to 80 or 85% of the home's value. So that gets you between 80 and about 90,000 of your down payment from your home that you can use towards the purchase of a new home. So the pros are it makes you a competitive home buyer and you don't have to move twice. But the cons are that it's harder to qualify for because there's 3 payments and that you might have to make 3 payments after you have closed on the purchase of your new home. When I'm working with you as a buyer, I'm literally putting it out on a calendar so that we can look at a real life example as to what your monthly payments will be and when if your home is not sold quickly after closing. I told you about a couple of alternatives if you don't qualify. Number one is if you've got a pre-existing home equity line of credit, if you qualify for the new loan, you already have that one, so you don't have to go through the qualifications again. You can draw on that towards the down payment. Or another common strategy is to use a 401k loan. Now these I would advise you to talk to your financial advisor, but 401k loans typically have no penalties to them, and they're not a good idea for a long-term loan. But if you need it for the short term, for a month or two, when you're borrowing against your 401k, you're borrowing against your own money, making it inexpensive financing, and you don't have to go through qualifying for it. So if you've got a large 401k at your work, many of them will allow you to borrow up to 50% of the 401k not to exceed $50,000. Or you can use it in combination with gift funds or other type of financing that is secured by an asset that you own. Realistically, if we get outside of bridge loans, I really like to look at a full application so that I can help a buyer make that decision about where they could source a down payment, because it's not always immediately obvious. So who are bridge loans best for? It's borrowers that have got strong income, great credit, generally speaking lower debt to income ratios, and who are not afraid of having a period of time in which multiple mortgage payments might be required. And finally, for the buyer who has found a dream home and does not want to let it pass up for the lack of a down payment. If you're wondering whether you can make a non-contingent offer, I'm glad to run numbers with you. Hey, thanks for taking the time to be with me today. My name's Peter Lindquist, and have a great day.